My name is Arun Bhattacharjee, and I'm a managing director on DTCP's growth equity team. I focus on investments in growth stage enterprise SaaS and PaaS businesses. Previously, I was at Google Cloud working on strategy and operations. This is the second annual Repeatability Conference, which started yesterday. I'm co-hosting Repeatability with my friend Dmitry Dakhnovsky from Stereo Capital. Repeatability focuses on topics related to growing recurring revenue technology businesses, particularly in enterprise software. We'll discuss metrics tracking, sales processes, fundraising, board governance, and more. Today, we're going to start our discussion with Christine Edmonds from ICONIQ Capital. Christine, would you like to tell the audience a bit about yourself?
Thanks, Oren. Hi, everyone. It's really great to be here today and excited to share some of our recent work. As Oren mentioned, my name is Christine Edmonds. I'm a partner on ICONIQ Growth, and I head up our analytics team. I've been at ICONIQ for about 4 years now and have really seen the whole team evolve, but thought I might actually start sharing my screen now to share a bit more background on ICONIQ Growth and analytics more broadly. So for those of you that don't know us, ICONIQ Growth is a technology investment platform really focused at helping entrepreneurs back entrepreneurs. What do we mean by that? Our LPs are made up of a quite unique set of, for the most part, individuals. They themselves are leaders, founders, CEOs across both leading technology companies as well as Fortune 500 companies. And they really see ICONIQ Growth as their vehicle to investing in the next generation of leaders and industry defining companies. Part of our investment platform is the foundational belief that we are really here to be long-term partners to the companies that we've made investments in. And the way in which we do that is really supported by what we call our portfolio engagement team. That has a number of different dimensions in terms of how we partner with the leaders across our companies, one of which is analytics. So what is analytics? Analytics was really founded on the understanding that we are extremely fortunate to have worked with so many amazing companies over the past almost 10 years now. And as part of that, really learned along with them on these journeys as they scale from, in many cases, $10 million all the way up to IPO and beyond. And so we've had the fortune of working with some companies that are now public, like Snowflake, Datadog, Procore, Braze, as well as many that are still on that journey, including Miro, Service Titan, and many others. The way in which we work with these companies is varied, but one of the primary motions we do is publishing thought leadership. And we're really fortunate to be able to share that not only with the amazing companies that we are investors in, but the broader community as well, really with the belief that we can all really learn from each other. So we'll share a little bit about that today. We also do quite a bit of bespoke analytics and one-on-one advisory with our companies. And then the balance of our time is spent really applying those same data frameworks and data science approaches to internal applications to support our broader investment platform.
Great. Thanks for that intro, Christine. You've obviously put together a lot of really good work looking at data from private software companies. So on that note, when you've done your research, what patterns have emerged when you think about data that's best to look at first and then second level that is predictive of how a company will perform versus just what everyone traditionally looks at? Said another way, what kinds of data points do you like to focus on that really are leading indicators of high performing companies?
Yeah, so I'm going to introduce a framework that we have. Before we get to that, maybe I'll just share a tiny bit more background on where this data is coming from. This is all based on real company data. So the benchmarks that we're going to share today are not theoretical, but really grounded in a set of over 90 companies across our portfolio, as well as a subset of public companies that we've identified to be truly best in class as they approach IPO. The concept that we're going to use to talk through this today is a term that we've branded as the ICONIQ Enterprise 5. I know everyone here is super excited to hear about more metrics that investors track, but I think to Oren's point, what we really want to highlight today is not just, the surface level of these metrics, but what's under the hood behind each of them, and also how to think about all of these in concert with one another. So for the most part, we'll talk about sort of the evolution of what's mattered and or currently matters more on the spectrum of growth versus efficiency, but there's really important pieces across all of these. Again, each of these metrics I'm sure you've heard of and seen of before, but we'll spend some time double clicking into each of them and then a little bit later on going a level or two deeper as well. So to start, we have lived in an environment where growth trumps all, and we'll talk a little bit about how that's changing, but obviously top line growth still remains incredibly important. And we have consistently seen our top performing companies be able to double or triple their revenue in the first 2 to 3 years and consistently continue to increase the dollar amount of net new ARR they are adding, even as they're approaching $200 million of scale. We know it's incredibly hard to get to $10 million of ARR. It is even harder to continue to scale beyond that. And so in a bit, we'll talk about how to understand the predictability of that growth and make sure that there is sort of the right balance in terms of the composition of where that net new ARR is coming from as well. Before that, though, just to hit on some of these other metrics. So net dollar retention, I'm sure, is another metric that many of you have heard of and track yourselves. The numbers on this page might be a little bit daunting, but wanted to share just a couple anecdotes of how companies that we've worked with have been able to really hit these numbers and in many cases exceed them. On the net dollar retention side in particular, I think really important to recognize that even in times when the market may be naturally more churny, like 2022 and likely next year as well, the ability to upsell very consistently and effectively is critical. So 2 examples here. Datadog is one that I think has done an extremely good job of rolling out incremental products throughout their journey of scaling and capturing incremental dollars along with that. Snowflake's another example, different motion in terms of how they really build that upsell, but as a usage-based model and a product with a huge value proposition to many of their customers, continuing to increase the ACV across their companies and customers on an annual and go forward basis has also been a real strength of theirs. So both of those, are probably closer to 150% in many of these years, and as a result have been, rewarded handsomely in both private and public markets. So I alluded to this a little bit. What actually matters though? Is it growth or is it efficiency? And this is a chart that I'm sure many of you have seen in various formats across this year. A lot of banks have put something similar together, but in the most simplest way to look at this is understanding in the public markets, when we look at how companies are valued, what's the correlation of the various metrics that underlie those companies? And if you look at this chart, the way to think about it is when the green line is higher than the blue line, growth is really what's driving that valuation. When the blue line is higher, that is flipped. So here we're looking at Rule of 40, which is a fairly simple measure of efficiency. It's annual growth rate plus free cash flow margin. And what you'll see here is really starting early 2020 up until second quarter of this year, growth was truly what mattered, far beyond any measure of efficiency. That has started to change. And again, this is up through Q2. I think Q3 results are rolling in rapidly, and we expect this to continue to flip. But regardless of markets, feels very overdue to have some increased inefficiency. So what are we talking about when we're talking about efficiency? There are a variety of ways to look at this. I think the area that in many ways is sometimes the easiest to quantify and conceptualize is efficiency across your go-to-market teams. So for every dollar that you're investing into your go-to-market engine, your sales teams, how many dollars are you getting out of it from a net new ARR standpoint? That we look at this on both a net and a gross dollar basis, but what's great about this metric in particular is it takes into account the time lag. So assuming that most sales cycles are somewhere within that 3-month period, obviously there are many exceptions to that, but assuming that's the case, we can kind of look at this quarter's net new ARR over last quarter's spend. And this is a metric that will naturally decline as you scale from that $10 million mark, but consistently see, again, our top quartile companies maintain a net magic number over 1x. And for product-led growth companies, this is actually often much closer to 2x. So the final metric I'll run through quickly here, and then we'll start to double click a little bit, is thinking about efficiency and productivity. One of the questions that we often get when we start to think through efficiency is, okay, but how do I make sure that I'm still feeding that engine? Am I going to lose productivity? And am I going to hinder my growth as a result? The short answer is no. We've seen both of these scale over time with most of our companies. And in fact, you can see here that right at the $100 million mark, when we look at annualized OPEX per FTE relative to ARR FTE, they actually flip in terms of the relationship between the two. For most SaaS companies, somewhere around 60 to 75% of your OPEX will be personnel related. And so this is just a really easy way to sort of think through the costs that you're incurring and the ARR that are being produced by each of your employees. If we were to extrapolate this up through IPO, we'd actually see this trend hold true. And so again, this is something that is really important to both track and understand, but ideally get more leverage out of each of your employees in terms of their revenue generation abilities as time goes on.
Great. That was a great overview of the metrics you track. Now, when you think about a company and their board, and they want to understand the health of their ARR. So your ARR may be X, but how much quality do you assign to that right now? And how do you think about the customer funnel? What are some tools you use to evaluate that? So say a company comes to you and they say our ARR is this, and you want to dig deeper and understand, okay, well, how repeatable is that? How likely is the retention to be high? What are some ways you look at that?
Yeah, so there are obviously a whole host of different ways to look at it, but the simplest way, which again can be implemented in very, very early stages, is really just understanding the actual ARR funnel in a very detailed manner. And so when we're talking about net new ARR, that is one number, but there are really four different numbers and different dynamics going on underneath the hood. One of the dynamics we look for when it comes to repeatability and scalability of growth is really the contribution of expansion versus new logo to gross new ARR. There, as in general, as companies scale, we see them increasingly be able to lean on that expansion motion and again, really upsell into a strong base. During times when markets are more turbulent and more volatile, this also becomes an increasingly important motion to have to be able to lean on. Having said that, it is incredibly important early on in the journey to develop the muscle to be able to capture those new logos for a variety of reasons. First, all of you that are here today that are founders, I have no doubt are in extremely competitive environments. And so unless you're able to capture some of those new logos early on, the base of customers in which you can ultimately upsell into further along your journey will be smaller. From a customer concentration standpoint as well, that's really important. And so that's where we get into the churn side of the equation and making sure that, you know, the majority of your revenue should not be made up by a very small subset of your customers. Again, there are obviously going to be nuances across different sales motions, different sectors, depending on what your product is. But I think for the most part, we want to see a healthy customer base and a mix of customers that all have the ability to be upsold into in the future. The other piece, again, moving towards more the efficiency side of the scale, is a metric that is, I'm sure many of you have seen again this year, but very simple to think about from a conceptual manner, which is the burn multiple. So in the simplest way, the way to think about this is for every dollar that you're spending, how many dollars of net new ARR are you generating? And when you're generating $10 million, we typically see almost $20 million needed to get there. But by the time you're at that $50 million mark, ideally that becomes much more of a one-to-one ratio. The importance of this metric is also how it's evolved over time. And so I think, again, something that's really top of mind today and this year, this, again, is almost 10 decades of data that we're looking at here. And when we actually build this chart for the last 2 years, again, companies have been incentivized to grow at all costs. And so many companies have actually scaled their burn multiple to 3, 4, or 5x. And again, so important to sort of bring that back into balance and drive to some of that efficiency. So we'll talk through some of the tactical ways in which companies are doing that, but really ideally are seeing this maintained around that 1x level as companies scale.
Fantastic. That is, those are some really good insights. And so when you think about leading indicators of resilience and health, so building on this concept of quality of ARR, if a company comes across your desk and you want to say, okay, the ARR has been this, it's been growing at this rate. How do I know that this is going to stand up in a changing market environment? How do I know that this growth is repeatable, right? Because an investor in a company, okay, the past is great, but what is going to happen going forward? That's more the concern. So what are some thoughts you have on that?
Yeah, so again, I know we're flying through numbers and all these slides will be available afterwards. We won't spend too much time here, but I think there are, again, dimensions across both absolute growth and efficiency, as well as relative to plan growth and efficiency that are really important to think through on both a longitudinal perspective, as well as a real-time what's happening today perspective. And so there are 5 metrics here that we really think about when we're trying to understand the resiliency of companies. Some of these we've talked about already in terms of absolute growth, absolute efficiency from a rule of 40 standpoint. The other metric that we keep a very close eye on every single quarter, honestly, regardless of the time we look at this last year and the year before, as well as when things might be more turbulent, is attainment to plan. Because I think this is an important way to understand a company's ability to really forecast their future, which in many ways is tied closely to the repeatability of their sales motion and their revenue generation capabilities. So one of the things we look at very closely is attainment of incremental net new bookings or net new ARR. And one thing, maybe just to look at the data in terms of what's actually been happening this year, we'll start with 2021. So 2021, anecdotally, all of us know it was an extremely strong year. When we actually looked at the data across a cohort of companies, we had a median attainment of that top line incremental plan of 97%, which is probably the highest we've seen in any recent history. Q1 in particular always tends to be a very strong quarter. It's close in temporal proximity to when most companies are putting together their budgets. And so Q1 2021 exceeded plan on average. Interestingly, though, the first quarter of this year, despite rumblings starting to happen, and I think a lot of folks starting to perk up in terms of the concern that they had, was also very strong, 99% median attainment. Maybe one data point of comparison there, I think in the most recent history at least, would be Q1 of 2020 during COVID. And that quarter had a median attainment of 80%. So again, we came into this year with very healthy balance sheets. Most companies had 2 to 2.5 years of runway, which is another very important dimension as we think about resiliency through this time. And we're really meeting their plan, really bolstered by some of that growth coming out of 2021. Going into Q2, of course, this impact accelerated. That median attainment dropped closer to 87%. And again, Q3 numbers are still rolling in and being finalized, but we are seeing further impact as the year progresses. And the other way that we look at this is for companies that ended their quarter in June versus July or August, we could sort of see that incremental impact starting to accelerate. So again, speaks to how quickly things can change in these environments and how important it is to be thoughtful and proactive about some of the action items that will be taken to really think about balancing costs in a meaningful way if needed. On the public market side, very similar story. I think Q1, very strong, 95% of companies actually beat their management plan. And maybe more importantly, almost 80% raised their full year estimate. That's fairly expected and normal in sort of robust markets. But Q2 is where we started to see a little more of that conservatism come in. And so although 90% of companies were still beating management guidance, only 50% were raising plan. And probably most notable on this page is the percent by which they were raising that plan, only 0.2%. So again, starting to see some of that conservatism sort of creep in across a lot of how companies were predicting the next quarter or couple quarters to pan out.
Christine, just on that note, so one, I'll be interested to see how Q3 plays out, but it's interesting to see how public companies do with beat and raise and hitting targets. I'd be curious if you had any thoughts on how that looks for private markets, because for a public company, that's like a very widely distributed forecast, and for a private company, it's more within a smaller group. And so what are some thoughts you have on the accuracy of forecasting compared when you compare public and private companies?
It's a great question, and of course, varies quite a bit in terms of just the maturity of these companies, how sophisticated are their finance teams. I think the more and more that we've worked with companies, the early and earlier we've seen them start to implement some of this really rigorous tracking and ability to start practicing that forecasting motion. And that actually leads well into, how are companies actually managing through this? Because there are a level or two of, to your point, leading indicators that have to be understood to do this well. And so one of the first things that we looked at when we started to see the actual attainment drip is, okay, well, is this going to accelerate? What are some of the other leading or lagging indicators of impact to demand? How are your customers doing? And so when we looked at this is a survey that we put out in summer this year. We're actually actively refreshing it. So the next month or two, we'll have updated results. But you can see here, there are some nuanced ways to capture early in the process. Okay, we think in a quarter or two, maybe the pipeline isn't quite as healthy as we thought it is. Maybe sales cycles are starting to take longer. Maybe the persona that's buying our product is changing. And instead of, head of ops being able to buy this, suddenly everything has to go through the CFO because budgets are being more scrutinized. And so really thinking through it from the perspective of, how are your customers doing? How healthy are they? Are they starting to be delayed on their payments? And how might that impact your forecasting abilities is very important. So maybe I'll just continue to walk through some of these in terms of what we saw on the impact to demand and then how companies are navigating that. When it came to thinking through, again, every single company is being impacted in a different way, while everyone's feeling a little bit of, the headwinds of 2021, 2022 declining. Some of these are more likely to be part of budget cuts than others. And so the other way to think through it is, again, who is your buying persona? Is it a head of people where in general, we've seen those budgets more likely to be cut versus a CISO, a CTO buying a security product or something that feels like it is a true must-have versus a nice-to-have on the spectrum. And so again, just thinking through it from the health of your customer and your buyer is a very important way to think through that. And in turn, how are you shifting your go-to-market strategy? So we talked a little bit earlier about the importance of having the ability to lean on an expansion motion and upsell motion in times where sales cycles might be prolonged. It might be harder to have an incremental buyer come on, but for your existing customers that really understand your value prop and that have seen the ROI of it, that might be different. And what's interesting is, as of summer, most companies surveyed, almost 80%, had already implemented changes to their headcount growth on the go-to-market side or were considering doing it. And if you look at the right-hand side of the slide, it really mirrors the funnel of, where those new leads come from. And so less focus on top of funnel, where marketing more likely to get cut, more focus on customer support, renewals, really leaning on that expansion motion once again. So maybe one last view of data, and then I know we are coming up on time here. I'll spend a little bit of time talking about, again, how different companies are navigating this. But as I mentioned, we don't just look at top line attainment, but it's also really important, especially now, to understand bottom line attainment. So if you thought you were going to spend $10 million, how much of that $10 million did you actually need to spend to grow at the rate that you were projecting? And what's interesting is that as of Q2, most companies fell in one of two buckets. So the first bucket is this top right green quadrant here, where they were actually not only able to beat their top line plan, but do so while burning less than expected. One thing that's notable about this group is, on average, they were 3 times as large as the companies in those other cohorts. I think, again, just really speaking to the importance of a robust and mature engine being able to support this and navigate it and ideally think through some of these changes in advance. The second bucket that we saw a lot of companies fall into was this top left quadrant. So they missed their top line plans, but they were able to quickly pivot and start to manage costs in a way where they actually were able to burn less than anticipated. What's great is, when we thought about this in Q1 of 2020, most of the founders and leaders that we were working with were having to think through scenario planning, budget cuts for the very first time. And in some cases, they may have actually been too conservative, pulled back too much on some of their spend, as a result, hindering their growth, especially as things, for the most part, came back relatively quickly in Q2, Q3 of 2020. And so seeing a lot of those lessons being implemented this year has resulted in much more measured and thoughtful and proactive responses to cost management, where these are really hard and challenging decisions to make. And that maybe leads to this last slide here, just in terms of how our companies managing costs to ensure that they are staying very efficient as they continue to grow so that they can continue to scale through this period. Reductions in workforce is obviously very topical at the moment and something that is really hard. And that paired with hiring freezes is becoming more and more common across many of the companies that we've looked at. We hosted a event a couple weeks ago with some of the technology leaders across our companies. And one of them said something that I thought was really relevant during this time, which is just that there's never a less personal time to change your teams. And so really trying to reorient this as an opportunity to put together the best team, the best leadership group, and set yourself up so that when things do start to pick up again, you can hit the ground running. And I think if we look back at sort of examples from 2008, 2020, many of the companies were able to leapfrog some of their competitors by using this as an opportunity to really think through, are they focused on the right things? Do they have the right team in place? Are they saying no to the right things? For many of our companies, it's a matter of reprioritizing, thinking through, do we really need to expand internationally? Do we really need to launch that new product? Or do we need to nail what we're really doing? And so obviously, again, no, it's not one size fits all. There's a lot of different tactics being used here, but using this as an opportunity to think through, how are we going to really bolster our growth and be set up so that when things do pick up back in speed, we have everything in place to really continue to scale efficiently.
Okay, fantastic. Christine, thank you so much for your time. I really appreciate it. And have a great rest of the day.
Thanks, Soren. You as well.